The global economy after an Iran war recession, inflation, and financial shock.
Welcome to the bigger perspective.
The movement begins quietly, not with explosions, not with headlines, but with numbers. On trading floors in New York, London, and Singapore, screens flicker as energy prices begin to shift. At first, the changes are small, then they accelerate. Analysts lean forward, phones ring more often. Across global shipping networks, route planners adjust trajectories. Some vessels slow, others wait. Insurance costs update in real time. Airspace authorities issue revised guidance. Flight paths curve away from areas now considered uncertain. Meanwhile, in homes far from the Middle East, the first signs appear differently. Fuel prices tick upward. Transport costs begin to rise. Groceries edge higher. The connection is not immediately obvious, but it is already in motion. Because when conflict involving Iran disrupts a system as interconnected as the global economy, the effects rarely stay confined to one region. They move through energy markets, through trade routes, through expectations. The central question emerges. If a war involving Iran reshapes global energy flows and financial confidence, could it trigger a broader economic slowdown? And how deeply could that impact reach into everyday life? Today's episode examines how modern economies transmit shock, how markets respond under pressure, and what history suggests about the consequences of geopolitical disruption. The global economy has faced energy shocks before, and each time the consequences have extended far beyond oil markets. In 1973, the oil embargo triggered by the Arab-Israeli war caused global oil prices to rise sharply, quadrupling within months. The result was not just higher fuel costs, but widespread inflation across advanced economies. A few years later, the 1979 Iranian Revolution again disrupted supply, contributing to another surge in oil prices and prolonged economic instability. These events revealed a critical pattern. Energy is not just another commodity. It is a foundational input across nearly every sector: transportation, manufacturing, agriculture, and logistics. When energy prices rise, costs spread. And when costs spread, inflation follows. Today's global economy is even more interconnected. Roughly 20% of the world's traded oil passes through the Strait of Hormuz, making it one of the most critical choke points in global trade. That concentration introduces vulnerability. If disruption occurs, even temporarily, markets respond not only to supply changes, but to expectations of risk. There is, however, an important distinction. Modern economies also have more tools: strategic petroleum reserves, diversified supply chains, and advanced financial systems. These provide some buffer against sudden shocks. Some analysts argue these buffers could prevent a severe global downturn. Others caution that high debt levels and already elevated inflation could amplify any new disruption. Both perspectives highlight the same underlying reality. The global economy is resilient, but it is not immune. Beyond immediate disruption lies a deeper transformation. Economic shocks often accelerate long-term structural change. A sustained crisis involving Iran could reshape global energy systems. Countries may accelerate investment in alternative energy sources, renewables, nuclear power, and domestic production. Supply chains could be redesigned. Companies may reduce dependence on single region sourcing, even at higher cost, to improve resilience. Financial systems may also evolve. Periods of instability often prompt reconsideration of global monetary arrangements, trade currencies, and payment systems. This does not happen overnight, but trends can accelerate. The 1970s energy crises, for example, led to lasting changes in energy efficiency, strategic reserves, and international coordination mechanisms. A future shock could produce similar adjustments. But structural change carries trade-offs. Greater resilience often comes at higher cost. More diversification can reduce efficiency, and transitions take time. In the short term, economies must operate within existing systems, even if those systems are under strain. Several realities are clear. The global economy remains highly sensitive to energy price fluctuations. History shows that geopolitical shocks can transmit quickly through inflation, trade, and financial systems. Modern economies have more tools to respond: strategic reserves, coordinated policy, and diversified supply chains. But uncertainty remains significant. We do not know how long a conflict involving Iran might last. We cannot predict how markets would react to sustained disruption. And we cannot fully anticipate how governments would balance competing priorities under pressure. What we do know is this: economic outcomes are shaped not only by events, but by decisions. And those decisions are made in real time, often under uncertainty.
What are your thoughts on today's analysis? We'd value your perspective. Share your insights respectfully in the comments below. Thoughtful discussion makes these conversations stronger. If you found this documentary informative and balanced, consider liking the video and subscribing for more in-depth global analysis. Until next time, thank you for watching.